idea that, say the Bank of France, the Bank of England has only got 300 tons now, so it can't do anything. But, the Bank of France, the Bank of Italy, who are big holders, the Bundesbank as well, the idea that they can be corralled into bailing the Americans out on the gold front, forget it. It's not going to happen. Because for a start, quite a lot of that gold is already gone. They just haven't told us that it's gone. The situation now is actually very, very serious. And, the one thing that central banks are doing now is they're saying, look, we're going to hold on to our gold. I mean, we may be over-reporting the position by however many hundreds of tons, even thousands of tons in some cases, or hundreds anyway. But, we're not letting any more go. So the idea that you can have a new gold pool facility whereby central banks get together and they feed gold into the market in order to control the price, no, that's not going to happen. It cannot happen. What might happen is possible confiscation orders. But I think, again, there's a very big difference between FDR's confiscation order back in 1933 and today, because in 1933, remember that the dollar was on a gold standard. And so technically, there was absolutely no difference between possessing gold and possessing dollars. So there is this sort of legal loophole, if you like, that you say, right, okay, we're going to force you by law, by executive order, to swap your gold for dollars. But it's not as if it's being confiscated as such, if you see what I mean. The distinction is that it wasn't outright confiscation. You were getting compensated in dollars.
Right.
The fact that it was devalued by 40% within months is neither here nor there. But what does the Fed do now? I mean, does it turn around? It would effectively have to turn around and say, there is an exchange rate of 42.22 to the ounce, and you can bloody well take 42.22. Now, that would be confiscation without any doubt whatsoever. So the other option would be for the US Treasury to say, we will set a price, let's say, around about current market values, and you would be forced to exchange. But the problem is that I don't think anyone would go with it. The only people who went with the original FDR executive order actually were the banks, because they were forced by law, effectively. If you had gold stored in a bank, let's say in a bank's vault, or even in a safety deposit box in a bank, then you lost it.
In the intricate web of global finance, gold has always held a unique and pivotal position. Renowned financial expert Alasdair Macleod has consistently highlighted the critical role of gold in maintaining economic stability and the potential repercussions of its mismanagement. His insights shed light on the current state of central banks' gold reserves, historical precedents of gold interventions, and the looming challenges that could reshape the financial landscape. Historically, central banks have utilized gold leasing as a mechanism to manage their reserves and influence market dynamics. This practice involves lending gold to financial institutions, which then sell it into the market, aiming to stabilize or control gold prices. However, such strategies have often led to unintended consequences. The London gold pool of the 1960s serves as a pertinent example. Established in 1961, this consortium of 8 central banks aimed to maintain the gold price at $35 per ounce by collectively pooling and managing their gold reserves. Despite their concerted efforts, the pool collapsed in 1968 due to mounting market pressures and the unsustainable nature of artificially controlling gold prices. Macleod emphasizes that contemporary central banks are acutely aware of these historical pitfalls. Today, there's a discernible reluctance among these institutions to engage in large-scale gold leasing or sales. This hesitancy is rooted in the recognition of gold's enduring value, especially in times of economic uncertainty. Recent data underscores this sentiment. In 2024, central banks collectively added a staggering 1,045 tons of gold to global reserves, marking the third consecutive year where annual purchases surpassed 1,000 tons. This trend highlights a strategic shift towards bolstering gold holdings, reflecting its perceived role as a safeguard against economic volatility. The notion of reinstating a system akin to the London gold pool in today's economic environment appears implausible. The geopolitical and economic landscapes have evolved considerably since the 1960s. Countries with substantial gold reserves, such as France, Italy, and Germany, are now more inclined to retain their holdings. This inclination is driven by a combination of economic prudence and a recognition of gold's intrinsic value as a hedge against potential financial crises. Furthermore, there's speculation that some central banks might have already depleted portions of their gold reserves, a reality they may be reticent to disclose. This opacity further complicates any collective efforts to manipulate or stabilize gold prices through coordinated interventions. The prospect of gold confiscation, reminiscent of President Franklin D. Roosevelt's 1933 executive order, is another area Macleod explores. In 1933, amidst the Great Depression, the U.S. government mandated the exchange of gold for dollars to stabilize the economy, effectively removing gold from private ownership. However, the context then was markedly different. The U.S. dollar was on the gold standard, making gold and dollars interchangeable in value. Today, with fiat currencies not backed by physical commodities, any attempt at gold confiscation would be perceived starkly as outright seizure of private assets without equitable compensation. Such a move would likely face significant legal challenges and public resistance, rendering it a politically unviable option. In light of these challenges, Macleod advocates for a re-evaluation of gold's role in the global financial system. He posits that as fiat currencies face increasing scrutiny over their stability and value, gold stands out as a reliable store of wealth. Its intrinsic value, scarcity, and historical significance position it as a cornerstone for monetary stability. Investors and nations alike are recognizing this, leading to a resurgence in gold accumulation. This trend is not merely a hedge against inflation, but a strategic move to anchor financial systems in an asset with enduring value. Macleod's insights serve as a clarion call for both policymakers and investors. They underscore the necessity of transparency in gold reserves reporting, prudent management of national assets, and a cautious approach to financial engineering practices that obscure true asset values. As the global economy grapples with unprecedented challenges, from mounting debt levels to geopolitical tensions, gold's role as a stabilizing force becomes increasingly evident. Recognizing and adapting to this reality is crucial for ensuring long-term economic stability and resilience.
Now, there is another point which I think is desperately important to understand, and that is that if the Western central banks tried to come together to do anything like that, quite clearly, the New York Fed, on behalf of foreign central banks, is very short of gold, as we discovered. Not only that, but the amount of gold held, that 8,130 odd tons, allegedly, because we have no evidence that it actually exists. And it is very likely that the number is considerably less than that. Again, it's paper IOUs, because it would have been leased by, the Goldman Sachs and the JP Morgans and the Citicorps and all the rest of it of the day over the last, sort of 50 odd years, and particularly in the 80s. It would have been leased, sold into the market, proceeds invested in US treasuries. The lease rate or swap rate, lease rate would have been something like 0.5%, and you were getting over 10% on US T-bills. What's not to like about it? And these were geared. So how do you get the gold back? Well, it's gone. It's gone. And so what have you got? You got some paper IOUs sitting in the basement of Fort Knox, and so I think they're guarding an awful lot of paper IOUs. There may be a few bars for show. I don't think it's quite as the press have been saying. The idea that people in America are wanting to stack gold before 25% tariffs are introduced or whatever. I think if you look at the stands to delivery, which basically is the process whereby on COMEX, instead of closing out a futures position by selling out a long position or buying out a short position, the owner of a long position decides to take delivery. In other words, what he does, he stands for delivery, but he doesn't actually take delivery. What happens is that it gets reallocated within the bullion bank's vault position. Whether it's Goldman Sachs or J.P. Morgan or whatever. That there is however much gold you stood for delivery. You get a certificate from them saying that we're holding this on your behalf. So it's rather like an unallocated account, if you like. And the problem always with derivatives, and particularly with gold and silver derivatives, is that derivatives are credit markets, whereas the physical metals are not. I mean, they are delivery markets. And the point about a credit market is that you want to deal in credit. You don't want ever to have to deliver anything. Over the last 4 years, when I started collecting these statistics, the stands for delivery on COMEX have amounted to over 2,100 tons. In fact, including this year, the pace has accelerated since January the 1st, to the point where the stands for delivery this year, if it continues at this pace, will be over 2,000 tons this year alone. So You can see that this is becoming a problem.
The global financial system is heading toward a tipping point, and at the heart of this transformation lies the increasing recognition of gold's role as the ultimate reserve asset. While the first part of this discussion focused on central bank gold reserves, historical leasing practices, and price suppression mechanisms, this second part delves deeper into the future implications of gold's revaluation, the geopolitical shift away from the US dollar, and the potential consequences for individuals and economies worldwide. For decades, gold has been systematically suppressed to maintain confidence in fiat currencies, particularly the US dollar. The London Bullion Market Association, LBMA, and COMEX have served as the primary platforms for price manipulation, where massive amounts of paper gold contracts are traded without the equivalent physical gold backing. This practice has created an artificial supply of gold that does not exist in physical form, keeping prices lower than they should be in a free market. However, this system is now unraveling as more nations demand physical settlement rather than paper contracts. One of the most critical developments in the past decade has been the steady decline of the US dollar's global dominance. Once the undisputed reserve currency of the world, the dollar has faced increasing competition as countries seek alternatives to protect their economies from US monetary policy and sanctions. The dollar's role as the world's reserve currency has allowed the Federal Reserve to print money with impunity, leading to massive debt accumulation and inflationary pressures. However, this privilege is being challenged by nations that no longer wish to be at the mercy of US financial policies. China and Russia have been at the forefront of de-dollarization efforts, increasing their gold reserves while reducing their reliance on dollar-denominated trade. China's Shanghai Gold Exchange has emerged as a major hub for gold trading, operating on a physical delivery model rather than a paper-based system. Russia, facing economic sanctions from the West, has also turned to gold-backed settlements to conduct trade with its partners in Asia and the Middle East. These trends indicate a fundamental shift in global finance, where gold is reclaiming its role as a neutral, borderless, and trust-based asset. The biggest clue that gold is being revalued behind the scenes is the buying behavior of central banks. For years, Western central banks downplayed the importance of gold, labeling it a barbarous relic while simultaneously hoarding it. The reality is that central banks have been the biggest net buyers of gold since the 2008 financial crisis, with purchases accelerating in 2023 and 2024. While ordinary investors remain distracted by stock market speculation and cryptocurrency hype, central banks are quietly preparing for a post-dollar world. The People's Bank of China, PBOC, the Reserve Bank of India, and the Bank of Russia have been aggressively adding to their gold reserves, viewing it as a hedge against the instability of the fiat-based financial system. Meanwhile, Western central banks have been reluctant to sell their gold holdings, despite decades of pushing fiat currencies as the foundation of modern economies. This contradiction reveals a fundamental truth. Gold remains the ultimate form of money, and those who control it will control the next financial system. there is growing speculation that a major financial reset could take place in the coming years, involving a formal revaluation of gold. The current system, where the price of gold is largely determined by speculative trading on the COMEX and LBMA, is unsustainable. As more countries demand physical gold deliveries and withdraw their reserves from Western vaults, the real supply of gold is becoming increasingly scarce. This could lead to a situation where gold is repriced dramatically higher, reflecting its true market value. A gold revaluation could happen in one of two ways. The first is a gradual and controlled adjustment, where central banks officially raise the price of gold to stabilize their balance sheets and support their currencies. The second, and more likely scenario, is an overnight revaluation, where gold prices skyrocket as confidence in fiat money collapses. This could happen during a weekend or a public holiday, leaving those who are unprepared unable to adjust their portfolios in time. If a gold-backed financial system were to emerge, it would require gold to be valued at significantly higher levels to accommodate global trade and liquidity needs. Some analysts suggest that gold could be repriced anywhere between $5,000 and $10,000 per ounce if it were to fully back national currencies. This is not an unrealistic projection, given the sheer amount of fiat currency in circulation compared to the limited supply of physical gold. While gold is receiving most of the attention, silver is positioned for an even more dramatic revaluation. Unlike gold, which is primarily used for monetary purposes, silver has a dual role as both a financial asset and an industrial commodity. Silver is essential in the production of solar panels, electric vehicles, medical devices, and electronics, making it a critical resource in the transition to a high-tech and renewable energy economy. Despite its importance, silver remains heavily undervalued relative to gold. The gold-to-silver ratio, which measures how many ounces of silver are needed to equal the value of 1 ounce of gold, currently stands above 80 to 1, far above its historical average of 50 to 1. This suggests that silver has significant room for appreciation, particularly if industrial demand continues to rise, while physical supply remains constrained. Unlike gold, which is hoarded by central banks, silver is being consumed at an accelerating rate. Mining production has struggled to keep up with demand, and stockpiles of available silver are rapidly depleting. If gold experiences a dramatic revaluation, silver will likely follow, with some analysts projecting potential prices of $100 to $200 per ounce. Investors who recognize this opportunity now may see exponential gains in the coming years. As the world transitions away from the current fiat-based monetary system, investors must be proactive in securing their wealth. Holding physical gold and silver is no longer just a hedge against inflation. It is a strategic move to protect against systemic financial collapse. Paper assets, including ETFs and futures contracts, may not provide the same level of security in a crisis. The best strategy is to own physical bullion stored in secure, accessible locations. Additionally, diversifying storage across multiple jurisdictions can provide further protection against government intervention. Countries such as Switzerland, Singapore, and the Cayman Islands offer secure storage options that are less vulnerable to potential confiscation or restrictive policies. Those who fail to take action now may find themselves locked out of acquiring gold and silver when they need it most. The financial system is rapidly shifting, and gold and silver are regaining their historical roles as the foundation of monetary stability. The suppression of gold prices through paper derivatives and central bank interventions is reaching its breaking point, and as demand for physical bullion surges, a dramatic revaluation is inevitable. Nations around the world are preparing for this shift, with central banks aggressively accumulating gold while reducing their reliance on fiat currencies. The dollar's role as the world's reserve currency is eroding, and gold is emerging as the next pillar of financial stability. Whether this transition happens gradually or suddenly, those who recognize it now will be the ones who preserve and grow their wealth. The time to act is now. As inflation continues to erode the purchasing power of fiat money and global confidence in the central banking declines, the value of gold and silver will become undeniable. Those who secure their wealth in hard assets today will be the financial winners of tomorrow. Gold and silver are not relics of the past. They are the future of financial security.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.